So why is financial accounting, which results in financial reporting in the form of financial statements, important? You already know from introductory financial accounting that stakeholders, also called users, are parties that have a stake or interest in the business. Generally, they have something at risk, such as their job or their money or even their reputation. A very broad definition of users or stakeholders is anyone who either prepares or relies in some way, shape, or form on financial information. Let's give a few examples. Management prepares financial information for external stakeholders, such as investors, creditors, or analysts. Their stake is that they want the business to be profitable and to grow. They need money to do that. Investors or potential investors rely on financial information to decide whether to buy or sell the business's shares. Their stake is the money they invested in the company in order to earn a return. Creditors, such as banks, rely on financial information to decide whether to give the business a loan and also what interest rate should be charged to the business on the loan. Their stake is the money they lend. Financial analysts review and monitor financial information so they can advise their clients on where to invest their money. Their stake is really their reputation as advisors to their clients. Notice that the majority of stakeholders use financial information to make resource allocation decisions. Resources, by which we generally mean money, are limited, and stakeholders want to use their resources to get the highest return. They really want to use their resources effectively, so they need financial information to assess the business accurately and on a timely basis. Using financial information, stakeholders can compare different businesses, and they can choose to invest or lend money only to those businesses who will use those resources efficiently. That means the highest return for the lowest risk. Stakeholders can only make that assessment by using financial information. Through financial reporting, businesses provide financial statements to external stakeholders so that they can, in return, receive resources. It's a cycle. Businesses give information to the stakeholders, and the stakeholders, through debt and equity markets, give resources to the company in the hopes of receiving more resources, meaning money, in the future in the form of returns. Returns such as interest on the debt, dividends on the shares, or increases in the share price. So why is financial accounting important? Because it allows businesses to obtain resources and stakeholders to obtain returns.